Let's get more on the drop in oil prices with Paul Sankey, lead analyst at Sankey Research. The last time, Paul, you were with us, you gave us a bold pairs trade, sell ARC by XOP. But we want to first get your take on this commodity crush. What is going on specifically in oil?
Well, I mean, firstly, just to second what Tim's saying, he's dead right. These are better companies with better managements and better strategies. I thought Friday was a big day insofar as obviously we had a big leap in the treasuries. And then you saw, for example, the OSX, oil field service names, and the oils ripping. And I was hoping we'd see follow through today. So I'm frankly a bit disappointed about today. And I think, again, comments that you've made coming in, listening to you guys coming in about the dollar, maybe a big part of the problem here that, maybe the jobs number, which looks great for oil because ostensibly the economy's strong, there's too many jobs and not enough people to fill them. That's going to be bullish demand. And then, to see the action on Friday, which was great in that regard, I was a bit disappointed we didn't get follow through, but, that's just 2 days of trading. On the COVID stuff, it's been really disappointing because we still don't have international jet travel. And that's, that very high consumption in terms of oil demand, jet fuel demand, obviously. So whilst the TSA numbers are back almost to pre-COVID, just about there, obviously the nature of the travel is very domestically oriented. And so I still think there's a couple million barrels a day more demand from jet fuel to come back in, which is key. And that, it's been a disappointing, since I made that call, the demand COVID stuff has been definitely disappointing.
Yeah, I mean, just over the weekend, Goldman Sachs lowered its GDP growth forecast for China. I believe it's to 8.3 from 8.6% for the full year, and really dropped it for the third quarter, Paul. When you see data points like that, does it really get you concerned that oil could see a much lower level from where it is right now between now and the end of the year? I mean, you may think by the end of the year things sort of normalize a bit more, but is there a rough patch ahead for oil and for oil equities?
Well, it's so tough because anything in China sneezes and oil's in bed with pneumonia, and that's been so tough because we just don't really know, do we? It's so difficult to know what's happening at the margin with Chinese demand and everything else, and whether COVID, is really as bad as you might read. So it's definitely a concern. I think that the dollar, the oil has been very strong in light of the dollar actually holding very well here. So that's been quite positive. I was hoping that we'd see more of the original bull argument we had on the oils, which is you're going to see an inflationary environment as demand comes back. You're going to have to see higher rates. You're going to see higher inflation, and you're going to see a weaker dollar. And on Friday, we got some of that, but not the weaker dollar. And I think that's been the problem. I am worried about China, but at the margin, I think we're going to get through this COVID stuff, either live with it or come to terms with it in a, I think we're at maximum fear of a resurgence type thing right here. And I don't know. As you can tell, I'm very hesitant about China. I don't want to second guess what could go wrong with oil in China because it could be negative. Yeah.
Hey, Paul, when you go back in history and look at oil prices, how have they done in periods of stagflation? That just seems to be a term that we kind of keep hearing more and more. It kind of help explain maybe this kind of odd situation that we're in as far as the global recovery and how we might have fits and starts. So is there any data that you have about stagflation and how oil acts?
Well, I mean, it caused it, right? So that back when in the '79 oil crisis, the Iranian crisis, that was really triggered in a lot of ways by oil. The U.S. economy was hugely oil dependent. You were using oil in power generation, never mind, driving huge station wagons that did 10 miles to the gallon. So that was originally the problem. What then happened, of course, is that because of stagflation, but because of high oil prices, oil demand fell enormously. And oil was horrible for 20 years, to be honest with you. So it's a bit of a concern. But generally speaking, I think that if we're in an inflationary pumped environment, I still think that if the economy's going, oil's going higher because demand will be strong. The issue in the previous stagflation was that we were so inefficient in our use of oil that you just transferred away from using it. And so it was very, very negative on the demand side. It wasn't specific to interest rates or inflation as much as just changing behavior because of the overdependence on oil back then.
Paul, I want to get to your famous, perhaps infamous pairs trades, which you lay out on the show almost a year ago, August 25th, 2020. You said to sell Apple, buy Exxon. At the time, I think we gasped because that was definitely a contrarian call, but that's worked out. Apple is up 15% or 16% since then. Exxon is up 36%. So you pick the winner in that pair. Some of your more recent ones haven't really worked out as well so far. One is sell Tesla by EOG that you made in January. You also said in May to sell ARK, the ARK Innovation ETF, which is up 11.6%. Sell the XOP, which is down. Buy the XOP, which is down 4%. Do you stick with these trades? Do you ultimately think? The overarching theme to this is oil equities will outperform technology.
Yeah, no, listen, by the way, I say I've never been wrong. It's just my timing is sometimes off a little bit. But it's also a couple of those trades were ahead, as you know, early on. And then this shift that we got in rates, it just ran me over. I just did not think, and I'm the wrong one, I just did not think that rates would rally from the 31st of March the way that they did. That is to say, interest, effectively the T-bill gets stronger and rates go down. And that ran me over because obviously that's huge for big tech and negative for big oil. If we get an inflationary environment, we get rising rates, that's going to destroy these extended valuations for long-term high multiple companies like Tesla. I'm really high conviction on long EOG, short Tesla. Tesla's crazy overvalued. Love the story. I think it's a fantastic company. Just the valuation is 4x what it should be. So that one I'll stick with. On the ARK, yeah, we're still staying short that. That's in the same boat. They're massively long Tesla as it happens. So I still like that one. And then, as I said, I'll add for you today, we're going to go long FANG, short FANG. So we're going to go long Diamondback, ticker FANG, and we're going to short the mega cap tech. So we're going to keep riding this. And, I think the key point that I want to make is made by Tim. These are better companies with better managements, with better cash return strategies. And the really noble thing to say is their equity value is lower than the present value of their future free cash flow. So these are not greater fool stocks. You're not going to sell it to some further sucker down the line. It's about getting a better return for your equity investment than you expect because you have higher returns over time. It's very classic Warren Buffett style valuation methodology, and I believe in it, and I think we're sticking with it, however much GameStop goes up.
We'll check back with you, Paul, on these. Thank you. Good to see you. Paul Sankey of Sankey Research. Tim, I'll go to you. Long FANG, short FANG? Long FANG Diamondback, that is. Well, short FANG, the tech stocks.
So Paul's a brave man. He's a wise man, and I'll let him make those pairs trades. But it's understood, and I think you were framing that. The point was there were a group of equities that were overdone and on the way up, and the energy trade was part of I think just a structural change in how these companies are run at a time when demand has come back, and you also have the tailwind of companies that were actually starting to deliver. So look, Diamondback is a story where they're going to increase their div by about 13%. They've committed to paying 50% of free cash flow, giving it back to investors. They've stressed that any M&A they do has to be free cash flow accretive. This is unheard of 5 years ago, 10 years ago in the oil space when it was all about growth at all costs. I think, we've been talking about demand. I think the more important story at some point is going to be the supply side. And I think there's a lot more capacity discipline inside of the oil space and OPEC Plus. And even in the U.S., I think there's calls by companies who, Permian is really where they operate at Diamondback to say, hey, I don't think the U.S. needs to increase capacity here. And I think a lot of these guys know that.